Hi, good afternoon, everyone. It's great to have Jay with us again, and especially now. I mean, after being on the road 2 years after COVID, and so I love to hear about your trip to Mexico. It's also a place I used to visit a lot, and enjoyed it. So tell us about it, Jay, and especially starting with the anecdote on the ride, back from the airport, and because that's something we always did, covering emerging markets. It's always a good check, looking at how much the taxi ride to the airport costs.
Absolutely, Roberto, and great to be with you and the OM audience again. So yes, my first visit outside the U.S. anyway, marketing in 2+ years since pre-COVID, and it was in Mexico, which of course, as you know, you visited many times, and certainly for myself, I spent a lot of time in Mexico at the early part of my career when I was on both the buy side and the sell side, focused on Latin America with Morgan Stanley. So for me, it was great to be back. And Mexico City, as you know, a big city like Sao Paulo, like New York, like London. Lots of energy. I would say pretty crowded, pretty active. The hotel that I stayed at was quite busy, and yet the taxi ride was very cheap. I mean, to give you an illustration, the Uber going from Manhattan to JFK was about $80, $79 and change, 45 minutes. The same roughly 45-minute trip from the airport in Mexico into Mexico City cost the dollar equivalent of $15.
Yeah,
So almost
amazing.
an 80% discount from the New York price. And that's a big discount relative to past periods. And used to do the same going to Brazil or going to Turkey or any other, China, the same thing. Always look at that. And I corroborated that with a Starbucks price check one afternoon, needing a little bit of energy after,
Yeah,
4 meetings.
how much did it cost?
Um, and the Starbucks a latte cost 47 pesos, Mexican pesos, which equivalent at about 20 to 1 was about $2.50. And when I got back to New York the other day, I went into a Starbucks just to check the price, and a latte cost between
Cost double, yeah.
4.50 and $5.
Yeah.
So again, 50% discount. So I think, we all know emerging markets, financial assets, whether it's the currency or yields on local currency debt or, PEs on equities is very cheap. But this really kind of brought it home. You don't typically find, an 80% discount on the taxi ride. So it set the stage for what was a great 3 days of meetings, mostly with the large Mexican pension funds, which are known as Afores. We also met with some family offices, large family offices, as well as some of the big insurance companies. So it was a really good opportunity to get the pulse of what these big institutional investors in Mexico are thinking about.
No, and they something I remember is, and that's true of the Afores, but also of policymakers. The local investor community base is very sophisticated in Mexico, so they are well informed. They know what's going on. So tell me, what are they asking? So I guess from your note, the number one question was whether we did have a bottom in June.
Right.
Uh, but can you give this a little bit more color?
Yeah, no, that was the question. Certainly, pretty much every meeting was raised either at the beginning or at some point during the meeting. And, I went through my point of view, which is that bottoms are a process, not a date certain, that we had made some pretty good ground over the last couple of weeks. The S&P was up 4 weeks in a row until last week. And that, we had a lot of good technical kind of achievements, breadth thrusts and things of this nature. I also noted in our own work that, for example, our TPW20 thematic model portfolio, when we updated it just before the trip, I noticed that every single one of the holdings was above its 50-day moving average. And I checked that, I updated that over the weekend through Friday, and 19 of the 20 were still above their 50-day moving average through Friday's price action. And so I think we've definitely made some good strides, and I think we're now, doing a natural pullback. I mean, again, in typical fashion, pretty aggressive, right? 2% down on Friday, 2% down today. So we've wiped off, a third or so of the rally from the lows in June. And I think basically that the market is pricing in Jay Powell's speech this Friday at Jackson Hole. A lot of talk this morning from Larry Summers and others about how Powell has to be really aggressive and all this type of stuff. And I think that set the tone for markets. But, from my point of view, I think the pullback is healthy. I mean, the S&P was up 4 weeks in a row. Naturally, it's going to pull back. I think that's all well and good. To me, the market is now kind of pricing in 75 basis points in September, which I think is quite likely. And that's, that's only 3 weeks away. Just about a month away. The Fed meeting is on September 21st. August CPI is on September 13th. And so I think we're pricing in right now a 75 basis point hike. In my mind, that's going to be the last one of these big outsized rate hikes, right? The Fed will have taken rates from 0 to 75 bips, will put us at about 3.25 on the Fed fund futures rate. And that's, that's a big front-loaded, aggressive tightening cycle. And after that, I would expect the Fed to kind of, if not pause, certainly dial down the degree of basis points per meeting. And I think so for now, we'll see markets, we'll see how markets react these next couple of weeks. I am of the view that, and I've said it before and I've written about it, that we are in markets like the 70s and 80s, which typically showed that when inflation peaked, stocks bottomed. And that's what I think has happened. The analogy that we're in 2008 type environment or 2001, I think is completely wrong. 2008 was a deflationary, credit and bank bust, housing bust. And what we have in 2022 is an inflationary environment. So very, very different. So on that front, we had a good back and forth with people. I think many of the forays, like investors in general, have a fair bit of cash built up. And that's one of the reasons why I think the low is in, because there's so much cash and so many people mispositioned that on pullbacks, I would expect some of that cash to be put to work. And that's probably what's going to define, where we go from here. If that cash is put to work, if we're right on the Fed starting taking its foot off the gas a little bit post-September, then I think markets will be fine. If we're wrong and that cash is not put to work and the Fed continues to be really aggressive, then markets, risk assets in particular, will struggle.
Yeah. With respect to the Fed's to Powell's speech on Friday, do you think the market is looking more, towards? I mean, how much of an increase we're going to have now in September, or is it looking for? For how long rates are going to be up? Because it seems that some Fed directors last week were trying to tell the markets, okay, not so fast. Don't expect us to cut rates in 2023 because they're going to have to stay stronger for longer. so we don't make the mistakes that were made during the 70s. Is that more or less the case? I mean, which one do you think is the case, or maybe both?
Well, I mean, this was the second question, right? Naturally, you talk about the bottom, potential bottom. And then the next question was, the Fed and what do you expect the path of inflation to be? And, my view is that I think inflation can surprise, falling faster than people think. First off, I think a number of the kind of transitory price impacts, whether it's from the energy side or the commodity side, or things like used cars, all those things are rolling over very aggressively and continue to roll over. So, gas prices in the U.S. down dramatically, food prices
280, right?
down significantly, used car prices down sharply in August. So I think that those things are clearly going to support lower inflation. The real questions are twofold, right? One is labor and the other is housing. That's what makes up the core, and that's what the Fed focuses on. And those two tend to be, they don't move as quickly, obviously, as the things that are adjusting by financial market price action. And so on the labor front, we spent a lot of time talking about the quits ratio and the job switcher ratio, because that's the front end of the wage gain process. The people who are quitting jobs and taking new jobs are getting the highest increases in compensation and wages. So as that ebbs, and we think it should ebb, given that concerns are growing that the economy is slowing, et cetera, that's the front end of the labor environment that we want to be watching. And on the housing side, really it seems as if we're decelerating quite rapidly. If you look at affordability, housing affordability is now close to a 30-year low. If you look at mortgage applications, they're now at a 20-year low. So the housing market's a little tricky because it was so upset by COVID and the desire to get out of the city and live in the suburbs type thing. So it's a little trickier, but I think that's what we're watching. The rollover has been fast there as well. So my feeling is that as we go through the next several months, we're liable to see a pretty sharp deceleration in inflation. And that should support the Fed moving from 75 to 50 or 25 basis points as we go through the year. And to your question, or towards year end, and to your question about 2023 and rate cuts, I mean there are two things to note. One, that's quite a ways away, and in today's day and age, a lot can happen, and those expectations can change pretty quickly. The second point, though, is that the history of short, sharp market cycles, in other words, when the Fed raises and then moves quickly to cut, the market forecasting has actually been pretty accurate. So there's been a fair bit of work that's shown the handful of times over the last, let's call it 40 years from the early 80s, when the Fed moved quickly like that. Markets actually tend to have been pretty accurate in terms of timing that first switch from hike to cut. So we'll see if this time is, again, similar to that. But the way I'm looking at it is, we're big believers in market speed. We're big believers in things moving faster than they traditionally have. And so it would be not a surprise, at least to us at DPW, if we have that kind of reaction on the downside of inflation. And I think that's what the market's kind of looking for, right? To get to the next level, to break above the 200-day resistance levels for the S&P, for example, for a number of other parts of the markets. We need more confirmation that inflation has peaked and it's coming down. And, that's what we need to see over the next couple of months. And I think that we're likely to see it. and that's going to be supportive of risk assets.
Yeah, and there's also, I mean, you talked very much about the technicals, and I mean, I was speaking to some hedge funds, some people in the markets, and it seems like the market tried to test the I think it's 4320, right, level on the S&P. It did not succeed, but if it did, if it had, there would be a lot of money put to work, which seems to be exactly what you're talking about, right?
Yeah, and I mean, it's pretty aggressive to go from the depths that we were in May and June all the way up to the 200-day and then break it and go through. I mean, to me, it's much more normal that, as we've talked about, markets are, we're in an ahistorical period with a lot of uncertainty and not much history. And so technical levels are things that the algorithms can get to and can understand. And so it's perfectly, absolutely as expected that the market moves aggressively to that level and then sits. And now we're pulling back because some people, short-term traders, have made some money. A lot of that move was short covering. As I understand it, we now have the shorts laid out again. I saw some work suggesting that the net short position is back to a 20-year high. So we have the shorts out there. JP Morgan and others have come out noting how thin the positioning is, in the bottom 10 percentile of positioning across risk assets, according to JP Morgan. So there's no doubt that there's plenty of cash out there for people to get comfortable and to put that cash to work. That's the challenge. But once that happens, then markets will react. And that's one reason why I don't think we're going to go back to the lows of May and June, is because all that cash was raised and I think is going to be put to work as we pull back. And that's going to be, that will be one of the tests if in fact that happens. If we go straight back down, well, then obviously that's going to be wrong. I don't see that happening because of the view I just expressed on inflation.
Yeah, just writing it down. So, and you think so? What's really driving the market? I mean, of course, it's been an aggressive pullback the last couple of days. It's mostly the Fed, right? It's nothing to do with China or this panic, panic buying of energy in Europe, right? So it's mostly, or I don't know, 90% is what Powell is going to say on Friday, right?
Well, I think that, and people recognizing that we bumped up against the 200-day, we're not going to break it. So any kind of short-term money, and there's plenty of money in the markets these days that's short-term. That's not the investment approach that we take at TPW Advisory. We think it's very tricky to kind of time a market that moves as quickly as this one. So that's not our game, but it is what some people do. And clearly, when we went up to that 200-day and couldn't really break through it, then you have the natural pullback. But I think you do raise, some good questions, and certainly in Mexico City last week, Europe was a big topic. Actually, I was a little surprised because here in the States, people have kind of given up, I think, on Europe, and the Afores again makes sense because they're long-term investors. On a long-term basis, and we've talked about it, I think Europe looks very, very compelling. You've got the currency at parity. You've got stocks that are at 20, 25-year low relative valuations to the U.S. You've got bank stocks trading at half of book. I think there's a lot to be said for Europe on any kind of strategic basis. And that was kind of the discussion we had. It obviously centered around energy. I don't really get why the energy market, the natural gas market, has gone kind of haywire the last couple of days in Europe. I mean, I guess it's because they're going to shut down the Nord Stream pipeline again for a couple of days, but we've already seen that movie. I think much more importantly, and much more important, is that Germany is several weeks ahead of its schedule to fill its storage, right? Their first objective was 75% storage by September 1st. They met that objective last week. The other thing that's worth noting is that it looks as if they've made the decision to keep the nuclear plants open if they decide they need to. I mean, that's a huge change. And it really reflects that Europe and Germany understands it's in an energy crisis. And so even the Green Party, who, its whole origin was anti-nuclear in the 80s, 68% of the Green Party polled in favor of keeping the nuclear plants open. So I think right now we're at the kind of the crunch point for the energy crisis in Europe. If we get to the next month or two and we get storage at 85%, which I think is the objective for October 1st, 95% for November 1st, then once we're through, November, December, then the market's going to be looking forward. And again, I think you could see that energy price in Europe fall off the cliff very, very quickly once we get through the peak winter season, and it becomes clear that Europe has the capacity to keep things going and keep the lights on, keep houses warm, etc., because they've been able to fill that storage. And so that was really the thrust of the discussion regarding Europe. What is likely to happen? What's priced in? It seems to me that, and not just me, but others, that at least a mild recession is already in the price of European.
Oh, for sure, absolutely, yeah.
And unless we get some sort of a shortfall in storage, and thus a real risk of having to really ration things in the wintertime, it's unlikely, to me at least, that we're going to get a deep recession in Europe. And I just reminded some of the folks in Mexico City that the Q2 numbers for Europe were very strong, right? Earnings numbers and sales numbers were quite robust. And of course, a lot of it was energy, but same as in the US, but the numbers, earnings and sales were pretty robust. And much as in the US, and you were an analyst, you know very well that it's when people report Q2 that analysts tend to take down the second half of the year if they feel it's necessary, because in September everybody's focusing on the out year, and we're already seeing the conversation shift. People are already talking about 2023, 2024, etc. And so, for the most part, those numbers did not get cut dramatically for the second half of the year, either in the US or in Europe, which suggests that, the earnings bridge thesis that we've talked about here now for well over a month and a half, high nominal growth, supporting nominal sales and nominal earnings, and thus supporting the earnings picture, and that earnings being a bridge while we wait for inflation to roll over, that seems intact to me, both in the United States and in Europe.
Mm-hmm. No, that's interesting, and talking about numbers. I mean GDP numbers. I mean, I don't have that much of a grasp on EPS. I mean, it could be that the third quarter GDP is also going to be strong because of tourism. I mean, every place is packed, and I mean, the number of foreign tourists in Italy is back to 2019, or maybe it's even above. So people are really enjoying the summer, which is the first full summer after COVID, with no restrictions. And for the economies in the south and in the Mediterranean, of course, that's going to be great news. But some recession is going to happen. But I agree with you that it's not so much going through the winter, but as we are about to go into winter, if storage is full, then I think people may relax a little bit.
Yeah, markets are forward discounting mechanisms. As soon as they hit that, market is going to move past it and look past and recognize that, there's a whole nother cycle, a whole nother year for Europe to, generate more sources of supply for the LNG activity that they're trying to build out to manifest itself. I think that's exactly right. And your point about tourism is very well taken, because it's the same here in New York. I mean, tourism is flourishing in the city. And that reminds us that, Europe and the US, these are 65, 70% consumption service-driven economies. Yeah. And so, you want to focus on the BASF plant that, is worried about not having enough energy and might have to reduce its output. That's an issue for the company. But, to extrapolate that into Europe has to have a deep recession is, with very record low unemployment, with a very cheap currency. Europe has a energy issue that it needs to deal with, and we're crunch time on that in the near term right now, these next couple of months. And so looking through that, assuming some of that, much of it's already in the price, then you need to start thinking about what happens next. And the what happens next could well be we get through the winter okay. Europe is still, in decent shape. Fiscal support, next gen, fit for 55, the CapEx activity to deal with climate, to deal with the conflict, all these things that we've talked about then start to manifest themselves again.
Yeah, and there was, of course, the next couple of years are going to be tricky, and there was a large gas field discovered today. I mean, I saw the announcement today, and I talked to some people, and it seems to be news off Cyprus that was discovered. That's going to be operated by it's a giant gas field with Eni, the Italian Italian company, and also Total. So, and of course, it takes a while. So. And I guess it goes back to your view. I mean, you can see the glass half full or half empty. I mean, because this whole energy situation that can be an opportunity in terms of a lot of capex. So it works on energy self-sufficiency and independence from Russia. But from your point of view, is that happening, or is it just wishful thinking on my part?
No, I think it's absolutely happening, and I'm a big believer in regional integration, where our whole tripolar world of regional integration, Europe, Asia, and the Americas. Europe, this is driving Europe closer together, right? They're having to focus much more on energy sufficiency, as you pointed out, self-sufficiency. Have to focus much more on common defense. Have to focus much more on, joint financing. All these things which are playing out over time and will be, as I said, strategically very beneficial for European investments. At the moment, we're at that point of time where people are very unsure, and there's not enough confidence to take asset prices meaningfully higher. I think that confidence, much as with the Fed and inflation in the U.S., you want to see inflation rolling over in the U.S. In Europe, and we talked about this in our last monthly, right? We had three big issues. In the Americas, it was how fast does inflation roll over. In Europe, it was the path of energy prices. And then in Asia, it was China's ability to exit smoothly from the lockdowns and learn how to deal with COVID. So we discussed the Americas with inflation. We've kind of, I think, covered Europe with the energy outlook. And now, the other question, which was a big topic again in Mexico, was the outlook for China.
Yeah, and it's still going back to the same point in Europe and how much a recession is priced in. Just before we went on a call, I was talking to a longtime friend. He's a European fund manager, and I asked, okay, man, how serious is the situation? Is this panic buying of gas because of this, Russia showdown, and he said, yeah, I mean, some rationing is going to happen, but he doesn't think it's the end of the world. And I don't know if you saw that data, but I think the data for German gas consumption in the first half, I think the number was down like 15%. And the economy was not down 15%, and of course it wasn't.
Yeah,
So,
exactly.
so I mean,
Exactly.
we're dealing
We
with rich
use
economies, so there are ways they can, people can be more rational in the consumption, right?
Yeah, well, the other thing too, Roberto, is that there's a price on all this stuff, right? And Germany, which is really the epicenter of this, and arguably, made some strategic mistakes, which are now coming home to haunt them on the energy front and the dependency front with Russia. They had the idea that they would work with Russia and keep Russia kind of on side in terms of Europe as a whole, and that's obviously been blown up with the decision by Putin to invade the Ukraine. Okay, fine. And Germany has to kind of rejigger its economic engine because it's not going to be able to run on cheap fuel anymore. Okay, fine. But guess what? Germany now trades at a cheap or relative valuation versus the rest of Europe, as has been the case in the last 30 years. So this is the point. The market has priced this in. Germany, which was the leader and traded at a premium, now trades at a discount. And therefore, we can talk about all this stuff, but the markets are pricing every day, pricing this stuff in. And in the case of Germany, that's arguably pretty well priced in. And we'll see how it transpires. That's not to say that it can't go down more, but it is to say, as I made this point to the Afores, that if you are a long-term investor, 3 years, 5 years, 7 years, a pension fund type investment horizon, then Europe at this point, with the euro at parity, with regional integration becoming more likely, not less, with the UK example of Brexit out there showing people, no, they do not want to be the UK, right? So all this stuff about Europe disintegrating and, leaving the euro, all that stuff is just gone. So if you want to think forward, I continue to feel, and I've said it, for a year or so probably now, that Europe has a chance to win the 2020s, to be the best performing region of the decade. And everything that's happening, near term is a negative, medium to long term is a positive. Europe will emerge from this, I believe, much stronger. And of course, time will tell, but I feel pretty good about saying, buying Europe here and looking again at it in 2025, 2028, you're probably going to be reasonably happy with your investment return.
Yeah, no, I agree. And you talked about the UK. I mean, I think, things are pretty miserable there, right? I mean, I think there was a city that said that inflation can peak at 18%, in January, and they have a lot of issues to deal with. So it seems to be, of the big economies, the most complicated that we're seeing now.
Well, I mean, to me, Brexit in the UK is the example of nationalism not working, right? Yeah. Our whole tripolar world thesis is that globalization died with the financial crisis in 08 and 09. Nationalism, the idea that an economy can kind of go on its own, the UK is poster child for exactly why that does not work. I mean, they're in very big trouble economically, policy-wise, with very little flexibility to deal with it. And so, to me, it just reinforces that the kind of configuration of the global economy going forward through the 2020s is regional deepening, regional integration in Asia, Europe, and the Americas. And one of the points that we discussed a fair bit in Mexico, and I want to make sure we touch on China, but just to finish this thought, one of the things that we talked about in Mexico was the tremendous opportunity for integration in the Americas, driven by the need to deal with climate and recognizing the natural resources that exist in South America and in Mexico, and the opportunity to really drive the Western Hemisphere together is like, to me, is one of the single biggest strategic opportunities out there. And it really is kind of disappointing that U.S. policymakers just don't seem to be able to focus on it, that they're too busy supporting the Ukraine, which is good, too busy worrying about China, which is okay, but everybody needs an enemy, and sadly for the military-industrial complex in the U.S., that's China. But we're not paying any attention to the potential to integrate U.S. demand for clean energy with the America's ability to provide the building blocks for clean energy, whether it be lithium, whether it be copper, whether it be silver. I mean, that's the big opportunity. And hopefully, if not the policymakers, the corporate sector is going to increasingly recognize that. And that was one thing that was clear in Mexico, that, the integration of northern Mexico in the southern United States in terms of production is definitely moving with speed. In other words, the reshoring that's taking place in the U.S., the whole idea of an electric vehicle production, an electric vehicle battery kind of, people are talking about no longer a rust belt in the southern and middle of the U.S., but a battery belt. And a lot of those, the inputs for the batteries can come from South America, and it just
Chile,
used.
Yeah, it's like the triangle. It's Chile, Argentina, and Bolivia.
Yeah,
tri-border. Yeah,
exactly. So so that's what's kind of interesting, and maybe now they use that as a segue into kind of EM and China, because I did come away from this trip feeling more constructive about emerging markets than I have in a long time, and we can get into that. But the first thing that the Mexican Afores wanted to talk about in relation to EM was China. And clearly, that makes perfect sense. So, our view has been that China is in recovery, recovering from the COVID lockdowns, that the U.S. and Europe are slowing. So while U.S. and Europe are slowing, and we had a really nice chart that we pulled from our monthly, used in our deck in Mexico City, China is accelerating. So we have a desynchronized global economy. That's good. That's good for balance. That means it's less likely that the global economy goes into recession. So that's point one. Point two is that China, it looks to me, is finally recognizing that it needs to be more aggressive on the policy front, right? We had another interest rate cut focused primarily on housing. That's now the second since May. And mortgage rates in China have come down by over 100 basis points in the last 3 or 4 months. So now you can get a mortgage in China at 100 basis points less than in the United States, which is pretty interesting, right? Because again, as you know, typically in emerging markets, if you can get a mortgage, it usually is at many multiples of the interest rate in the United States. And so in addition to that, we had the housing kind of bailout package, which was announced over the weekend in China, supporting specifically $30 billion to support the finishing of all these unfinished houses, which is creating all the angst with homeowners who have put down the deposit, but you don't see the house yet. So they're focused on that. And in the interim period, you have the credit impulse turning up. You have M2 in China growing at about 12 to 15% year over year. So money supply is really starting to course through the economy there. And it's really interesting to me is to see the price action in some of the issues relative to the headlines. So headlines over the last week or two has been every day, right? Property disaster, housing disaster in China, big problems in China property. But yet we own in our global multi-asset portfolio an Asian high yield ETF, which is approximately 30% made up of China real estate developers. This is dollar denominated debt, yields about 9%, pays monthly, and has, while the price action hasn't been great over the last, 6 or 8 months, we've owned it for about that long. The dividends have kind of offset that a little bit. But here's the interesting thing. Over the last 2 weeks, since we updated the model, right, that Asian high yield ETF has been a top 4 performer out of all the 25 or 28 ETFs that's in the global multi-asset model. Asian high yield has been in the top 4, even with all the negative headlines. So that and you've heard me say this before. I like to let Mr. Market tell me, right? Not me trying to tell the market. And when I see just unrelenting negative headlines, and yet the price action at the center of the negative headlines is positive, that tells me that this is a lot, if not all of it, is in the price. So so I'm watching. I think we're at the turn with China. I think the government has finally recognized that it needs to act with some more force to stabilize the housing situation, to help drive confidence, to help the demand side, because China is a demand issue, not a supply issue, right? Supply chains have cleared, ports have cleared. It's a demand issue, and demand is still limited because they just came out of COVID, right? We came out of our lockdowns. I mean, I can't even remember when New York City was locked down. It was so long ago. Shanghai was locked down, 4 months ago. So, you have to kind of understand that they're behind timing wise coming out of the lockdowns. And so over time, and I do believe that, China is quietly moving away from the aggressive lockdowns of huge cities, being much more kind of tailored in their lockdown approach. That demand picture will improve. So in talking with the Afores, we were talking about a second half growth rate of about 4% annualized, right? The original target for this year was 5% plus for the full year by the government of China. They've given up on that, as well they should, because it's not going to happen. Now the question is, how does the second half look? And I'm of the view that second half growth, 4% or so annualized, as China comes out of lockdowns, as the policy action becomes more aggressive, as the money supply picks up, the credit impulse picks up, the property sector is being seen to be dealt with, demand comes back as the lockdown fear ebbs, that China not only supports itself, but supports the rest of Asia. One of the other charts we had in our monthly, and again in the deck, was that the renminbi is at a 30-year high versus the yen. So just imagine what Japanese exporters will be able to do as China demand comes back. Think about what it means for Southeast Asia, which is one of the places we added to recently when we updated the model 2 weeks ago. We added to Southeast Asia equity. So I think that to me, the China situation is one that is starting to improve. And I just, as a final comment, just note that, China equity bottomed months ago. If you look at KWEB, the China Tech ETF, it bottomed back in April. I checked today. It's still 22% above where it bottomed. So I don't think we're going back to that level. I think China is moving forward, and watching this high yield play as kind of the lead indicator for animal spirits to start to percolate a little bit in China.
And I don't know, did you see the comment from BHP? I think we didn't talk in the call 2 weeks ago, but I think I forwarded that to you by email, or I may have I may have tagged you on Twitter. BHP, the huge mining company, they had a bullish comment on China, saying that China coming out of COVID should be a tailwind for the global economy.
Yeah.
Exactly for the same reason that you're talking about. You said you were saying they don't have a supply issue; they have a demand issue. So here you are.
Yep, and that's right, and that's the desynchronized nature, right? U.S. and Europe
Yeah,
slowing, China, Asia picking up, desynchronized global economy, not synchronized, and that desynchronization is bullish because China will keep the global economy afloat, and that allows for Europe and the U.S. to start to recover. The Fed front loading rate hikes, Europe energy crisis. We're in the epicenter of that right now. September should be the last major 75 basis point rate hike for the Fed. The next 2 or 3 months should be the peak of the energy crisis in Europe. So as we go into 2023, 2024, which again, people are now starting to talk about because we're moving into that out year outlook. 6 months from now, we'll be in 2023. Then you look at a global economy that could be on the upswing. And that's where, one of the things that really came that I took away from the Mexico trip. And again, when you're out on the road and you're marketing and you're giving your presentation 15, 20 times, certain things resonate. You get pushback, you engage in back and forth with very smart investors. And as you pointed out, the Afores are very, knowledgeable, smart institutional investors. You solidify certain things or you discard certain parts of your presentation. And for me, the middle path, right, which was something we've talked about quite a bit, the middle path, high nominal growth, supported by global capex, driven by the need to deal with the 3 C's of COVID, climate, and conflict, underpinned by surging productivity. That, to me, is the path for the 2023, 2025, 2026 period. And interestingly, we're now starting to see others pick up on that point of view, right? JP Morgan is espousing a similar type of outlook. Oliver Blanchard, who was the chief economist for the IMF, wrote a big piece in Project Syndicate laying out the same case. And so I believe that the Fed is going
the nominal GDP.
And I believe the Fed is going to validate the nominal GDP world, not eradicate it. So I think the surprise is going to be that the Fed declares victory with inflation around 3%, recognizing that to get down to 2%, it will have to really damage the economy, and it's unlikely to want to do so. And it can declare victory at 3% for 2 or 3, I think, very good reasons. The first, which gets not enough attention, is the aggressive fiscal tightening that's taking place in the US. There is aggressive fiscal tightening taking place in the US right now, and that supports the Fed's monetary tightening. The second point is the very well anchored inflation expectations, right? The Fed most definitely does not want to see those inflation expectations become unanchored, and yet they're not. Inflation, if you look out 2 years, 3 years, right around 2 to 3%. So those inflation expectations, very well anchored, also supports the Fed's willingness to declare victory at 3%. And then finally, the secular forces of disinflation, particularly demographics, the aging of society, the shrinking of the labor force. These things they did not go away over the last couple of years. They were simply overwhelmed by the policy response to deal with COVID. Going forward, they're still there. And so to me, what's likely to happen over this next 1 to 2 years, 2 to 3 years, is the Fed gets inflation down, declares victory because of the things I just mentioned, and that unleashes that global capex boom, which I think is clearly needed to deal with the 3 Cs, as we've talked about many times, and the productivity underneath that comes through. And this was a real good discussion we had on the margin front, right? I mean, high nominal growth supports the top line. A lot of concern about margin erosion. And I made the point that, look, companies have been spending the last 2 years really grinding down on the cost structure, right? Because of COVID. So now you have a situation where companies have pricing power and they have very tight cost control, and thus you have very nice margins. And I think that sustains itself. I don't see companies all of a sudden, letting costs rip by any stretch of the imagination. And so I think, to me, this is the world we're moving into, not a return to the pre-COVID 2% growth, 1% inflation, 3 to 4% nominal growth. We're moving to a high nominal growth world, validated by the Fed, supported by global capex, nominal growth in the US of 6%, nominal growth in Europe of 4%. And those couple of percentage points difference, that's going to be the juice which provides the earnings, which underpins rising asset prices.
Yeah, no, I totally agree. And but I had a comment. I mean, kind of comment on China in emerging markets because I mean I remember in the good days, 2004 to 2007, good days for Brazil. Brazil was booming, and the Mexicans were complaining because they said, okay, Brazil is a client of China and we're a competitor of China. Of course, I wonder how much of that is changing. And with respect to globalization, and maybe this should be the subject of our whole session, but I don't know if you saw that, the Macs and if I'm not wrong, the iPods are going to be made in Vietnam now. Apple is shifting production out of China into other, emerging markets in Asia. And of course, Vietnam has been, a winner. And has been a success story for many years. I mean, how much of that talk there is in Mexico, of Mexico capturing some stuff coming out of China, and how much do you think there is a limit? I mean, because you can argue about a new Cold War and that kind of stuff, but companies like Tesla and Apple, even if they ship some production away, they cannot live without China, right?
Yes, and remember we mentioned probably 3 or 4 months ago Tesla as a tripolar world company because it has production in each region, right? It has production in China, it has production in Europe, it has production in the US, and all these things are coming together. The corporates are driving the tripolar world thesis right now. Is supported by policy, right? Because the policymakers in each region want to have their own semi-fab plant production. Yeah. They want to have their own electric vehicle battery production, like I talked about, from Rust Belt in the US to Battery Belt. Okay, the same thing's happening in Europe. CATL, which is the biggest battery maker, Chinese-based battery maker, just announced plans to put in a huge battery plant in Hungary to service the European electric vehicle production. So,
and guess who wants to make batteries now?
Yes, everybody.
Saudi Arabia wants to make batteries now.
Right. People recognize, because of the last couple of years, whether it's COVID, whether it's climate uncertainty, whether it's conflict, that they need to have more security of supply. And that security of supply is going to be centered in each region. Nearshoring, reshoring, friend-shoring, which is what Janet Yellen calls it, friend-shoring. And so Mexico now becomes potentially a very big winner. And that's what I mentioned. The northern part of Mexico is integrating very rapidly with the southern part of the United States. That's going to continue. You have the potential, as we talked about earlier, for that to be driven all the way through South America down to the tip of Chile, right? With the need for copper, for lithium, for silver. And so going forward, I think, and this is one of the reasons why I'm getting more bullish on EM, I think you're going to have Brazil do well because commodity demand in that global CapEx boom world, in that high nominal growth world, commodities will do well. Thus, Brazil will do well. In that desire to have security of supply and nearshoring and regional production, Mexico will do well. And so you're at the same time as this is starting to happen, you look at EM versus S&P, and you realize some charts that have gone around
the lows
the
of
last week or two,
2001.
you're right back to 1999, 2000 levels where EM bottomed versus the S&P and started those 5 years or so from 02 to 07 where non-US and EM significantly outperformed the US. And so we've been talking about this. It keeps being retarded or pushed back, but I think we're very close to that turn. And what's going to catalyze that turn is the dollar, right? The dollar
That's what I was going to ask you.
Roll over, and when the dollar rolls over, and this is what we talked about in Mexico, my bet is that as soon as the dollar peaks conclusively, every firm on Wall Street is going to recommend EM. You watch. You mark it down right here. As soon as the dollar rolls over, every firm, Goldman, Morgan Stanley, you name it, Citi, are going to recommend EM. It's like picture perfect in my mind. And so my advice to the Afores was you should start building those positions now. And of course, that's what we're doing. Again, in our global multi-asset model, we now have equity positions in China, in Southeast Asia, and in Brazil. We have fixed income positions, credit, in Asian high yield, and we initiated a position several weeks ago in EMLC, which is the emerging market local currency debt. And of course, as it usually happens, the dollar went on its best week in months and months last week. So our EMLC position, is underwater within 2 weeks of our putting it on, but that's okay.
It's always like this. With the best trades are always like this. They always,
Yeah, it's a 2% position, and if it continues to weaken, we'll buy some more. But I do think that we could be on the cusp of a big relative move back into EM. And EM, kind of traditional EM, like Latin America, as well as China. So if you get both the LATAM kind of commodity-based economies and China moving together, that's EM writ large, going forward and starting to perform. And the fact that we're right at the same relative level, EEM versus the S&P, people can punch it up. Look at the chart. We're right at the same point where it turned, 20 years ago. And that to me was one of the real key takeaways of the trip for me. Coming back from Mexico, having
that's
these
great.
discussions, that we could be on the cusp of EM outperformance. And so we're now overweight emerging markets. When we put all those positions I mentioned together, we're overweight versus our benchmark, not hugely, but we're overweight. And we're going to probably look to get more overweight as we go forward, should we see, signs of what we laid out happen. But the dollar, I think, is key. And I think the dollar starts to roll over when it becomes clear that the Fed is done front loading these big rate hikes, which I think will be next month. So I think we're weeks away from that situation starting to manifest itself.
That was my question right there. So you already answered. So I was going to ask you exactly. What is going to lead people to say that? And I guess the other part of the question was how much of what we're seeing now is dollar strength, and how much is the fact that people don't want to touch the euro? So I mean, I guess it's
Well,
both. I
it's
mean,
the
it's
euro. It's the yen. The developed economies, there's not much strength there. It's also the renminbi, right? It looks like the renminbi is going to weaken, is weakening against
yeah,
the dollar, and I think that's fine from a Chinese perspective. A little bit of weakness doesn't hurt on the export side, but I think mostly it's dollar strength because the Fed is the most aggressive central bank out there, and
yeah,
and people are comfortable with all this uncertainty with holding dollars. So as we get China recovering, as we get through the peak fear on the energy cycle in Europe, as we get through the peak front loading of the Fed raising 75 basis points next month, then I think conditions are for the dollar to start to weaken and people to start to move back into some of these other areas. And then you have a situation where these currencies are deeply beaten down. And so the opportunity for both currency appreciation and price appreciation is where you get the relative outperformance going forward. So that to me was like, as I said, one of the main takeaways was these next couple of years, EM could be a leader after being a laggard for, literally since 08, 09, EM has been a huge laggard.
yeah. No, fantastic. So I mean, we could be like 4 days away from that. If for some reason Powell says on Friday, I mean, if people believe that that's what he meant, that U.S. that the Fed is done front loading these rate increases, we could be there. So and normally, and normally what people do is they would recommend emerging markets for 2023. So I don't know, between now and when people make their next year outlooks, they're gonna say, okay, emerging markets gonna be like the new thing.
Yeah. Yeah. I mean, I don't expect Powell to say that on
Yeah, yeah, of
Friday.
course, he never would.
I
Yeah,
think, I think he's going to hold fire and say that, inflation's still too high. We need to see continued declines in inflation, et cetera, et cetera. But I do think come September 21st, a month from yesterday or whatever, the Fed will raise 75 basis points. And then that will be the last of these outsized rate hikes. And as that becomes clear, the dollar starts to weaken. And so, yeah, positioning in that is a little tricky. As I said, we initiated EMLC 2 weeks ago, and it's down 2%. So, but the other things are up. So it's all kind of in the wash. But ultimately, I think the opportunity is developing nicely for broad EM exposure, currency, debt, equity, and very few people own anything. I mean, Brazil trades at 6 times earnings, right? I mean,
yeah,
it's absolutely dirt cheap with the currency at 515, 520. So there's lots of upside. Once things start to move in the right direction, then everyone will pile back in. We're willing to be a little bit early at TPW Advisory. My history, myself, is I tend to be early. And so we deal with that by starting out with a 2% position usually, and then gradually adding to it.
yeah.
And that's what we've done with EMLC. It's a 2% position, and that's the starting point, and we'll take it from there.
That's great. I mean, we're 5 minutes over the mark, so it was a fantastic session. Lots of information. We'll be sending some of these snippets to the investors by writing. But that's great, Jay. Thanks very much. In 2 weeks, it's going to be exactly Labor Day. So before we talk, we'll decide if we'll do it on Tuesday or or the following Monday.
I would think Tuesday, my friend.
Yeah. Okay. So let's or we could do the following Monday. But
Yeah.
if you want to do it on Tuesday, that's fine. I'll book it for Tuesday now. So that's
Excellent.
great. And speak to you in 2 weeks.
Excellent.
And it was great talking to you.
Likewise,
Cheers. Bye
Roberto.
bye.
Thanks very much. Have a great rest of the day.
You too.
Bye-bye.
Bye.